Joining us here at Post 9 to discuss, Mona Mahajan, Edward Jones Principal and Head of Investment Strategy. Mona, thank you for being here. What do you make of Goolsby's comments there, and especially in light of what we've seen from the data over the past week?
Yeah, look, he has a point. This economy has held up to some extent. We have seen that certainly in the earnings picture. We're looking at 10% year-on-year earnings growth for the second quarter, on pace for double digits likely by the end of the year. That's a great sign for markets. We have seen, retail sales this morning points to it. The consumer has held up okay. Now, to the broader point of the economy, we do think we'll see a little bit of softening in the second half of the year, not recessionary. But really, the narrative has shifted now as we look into 2026. We're looking for lower interest rates by the Federal Reserve. We have a tax bill in place, by the way, that will probably start to kick in next year. And we continue to see the earnings growth story playing out in 2026. So not a bad setup as we head to year end.
So given those cross currents, do you think there is enough of a case to be made for, say, 3 cuts this year? What do you expect to see next week in Jackson Hole?
Yeah, it's a good point. Look, I think the market actually swung pretty far, pretty fast to the 3-cut scenario. We think 1 to 2 is more likely. We're still dealing with an inflation narrative with CPI above the Fed's 2% target, PCE likely as well. But I think what really shifted was that labor market story. We are now seeing a clear sign of cooling, not only for the July data, but of course the last 2 months prior to that were revised substantially lower. So a cooling labor market with inflation that we think remains contained to a large part would probably imply a Fed that will probably start to move rates towards a neutral level, towards that 3.5% or so.
Do you expect then to see, Jerome Powell next week kind of walk back this notion of 3 cuts, just given some of the inflation prints, give him more optionality as it comes to kind of the fall and in the winter timeframe?
Yeah, look, I think Powell usually uses this platform to signal if there is a shift in policy, a shift in narrative. We think he will use it to signal, 1, perhaps a rate cut is coming, 2, probably a 50 basis point rate cut is off the table at this point. Whether or not he'll guide to 2 or 3 remains to be seen. We think certainly he could guide towards a Fed that is now poised to move towards a neutral rate. So we do think a shift in narrative next week will be an interesting one to watch.
You mentioned the aggregate earnings growth numbers are looking pretty healthy. There actually even has been an uptick in forecast for the third quarter through this earnings season. So that's all positive, although it still continues to be dominated by the very largest stocks. So what does that mean from an investment perspective?
Yeah, it's a good point. Look, tech, AI story. We came into the year a little bit uncertain. Would they reaffirm CapEx and data center spending? Would we see revenue and earnings meet expectations? They have far exceeded on both fronts, reaffirmed the CapEx spending, not only met revenue and earnings guidance, probably exceeded that as well. So this is a story we think has legs. We think investors need to have exposure. It's a long-term secular story in AI and technology. Now, we continue to believe, though, that over time, it'll not only be the infrastructure players of AI and technology, we will see the sectors that will benefit from productivity, whether it's healthcare, whether it's industrials, whether it's financial services, they should all play some participation or have some participation in that, in those gains as well. So we continue to like a broadening theme, especially if the Fed is cutting rates here. We think tech and non-tech of the parts of the market will participate.
Interesting piece in the Times yesterday looking at electricity costs, which are running double CPI, in large part because data center is going to take maybe 12% of the nation's grid in a few years. Ken, you think they can both coexist, this run up by the giants to secure power without creating inflationary pressure for consumers?
Yeah, it's a good point. Look, I think we need to build out that electricity capacity, the energy capacity, the data center capacity, so that's in build mode. I think some of the CapEx benefits we're getting from the tax bill, for example, will help incent that. The inflationary story remains to be seen because on one hand, the AI and technology will help bring down inflationary pressures. They'll make costs more effective. On the other hand, you have the electricity and energy prices that we need to manage.
But you think margins benefit from would-be productivity in 26?
I think we should start to see it in 26. Part of that expansion to double-digit earnings growth is probably a margin expansion story that comes partly, hopefully, from the AI story.
What do you think needs to happen to see that margin expansion? Does the technology need to be better? Do CEOs need to be more comfortable with it? Or does the broader macro environment need to deteriorate to the point where they're kind of forced to make these decisions with laying off people and replacing them with AI.
Yeah, I think we're already seeing a little bit of that story play out in the labor market front. We are seeing a lower labor force participation, but even with some of the immigration policies, perhaps a lower labor force overall. And if you need to keep up your earnings growth with a lower labor force, productivity gains have to come into play. And I think using technology to supplement some of your, labor is probably the trend we'll see starting next year and continuing in the years ahead.
Yeah. It's a big question whether kind of executives and boards and CEOs will be forced to make these decisions or whether they'll do so kind of at their own choosing. Thank you, Mona.